Hey guys, this is the commodity report. Sorry for the delay today. Um, just some internet issues, but this is a commodity report with Kevin Green. We do this show every single week, talking to you about commodities and so on. So make sure you guys hit the notification bell if you're on YouTube. Make sure you guys stay up to date with all of us. Make sure to follow the speakers as well. We're all here just having a great time talking about commodities with you guys. So going through the commodities over a 1 month time frame, this is usually where we start off, just kind of seeing what's showing some sort of relative strength, what the laggards and the leaders are. So if we're going over a 1 month period of time, we're looking at cocoa is in first place, up 13%. Cocoa could be up 13% today and down 13% tomorrow. So we'll see how that plays out. The yen rate behind that is up 7% still in a 1 month time frame. Still pretty interesting move there, but it has come off quite a bit already. The U.S. dollar against the yen has moved up quite a bit. Lumber right behind that. Lumber's been interesting. Quite a move that's happened right off that major support level there. So lumber's started to move as well. Orange juice right behind that, up almost 6%. Coffee just underneath that, under 5%. Now it's sitting right under, and Sam and I were talking about this earlier, it's sitting right under all-time highs. So it's going to be quite interesting. We actually had an all-time closing high on a weekly closing basis pretty recently as well. So coffee could be one to continue to keep an eye out for. The fundamental picture is there, but we really need to break out to get above those zones so we can actually see us make a big run. 30-year bond rate behind that. Quite interesting to see the bonds start to tick up over 4%. Gold rate behind that, up almost 4% as well. And then just on today's moves, we're seeing natural gas up 5%. Now, Kevin and I can talk a little bit more about expirations and futures contracts going forward. But for now, natural gas up 5% today. Cotton's up 3% today. Cocoa up 3% today. Silver's up 2% today, making a nice move today. So we're seeing a lot of interesting things, and something we have been talking about is the precious metals bull market kind of taking shape. Seeing that silver is starting to perform is a good sign. So, Kevin, what are you seeing out in this market today? Anything of note that you're making notes of today?
Yeah, there's a couple of moves that I'm keeping my eye out on. First one is going to be silver. So silver pushing to the upside. It is up around 2% in today's session. And I think that's also in being reflected of maybe a little bit of optimism coming out of China. And that narrative pretty much is being recycled every 2 weeks, unfortunately, right? And so when you have that type of narrative, you start seeing maybe a little bit of a bid, not only for silver, but also for the grains, and then also for copper as well, where copper warehouse stocks in Shanghai have actually been coming down over the last week and a half, let's say week and a half. And so the fundamental picture itself as far as demand, but from the number standpoint, still not great. But the expectation that we are at a bottoming there is really what's kind of fueling these moves to the upside for a lot of these commodities. Now, one thing to just kind of keep in mind for the physicals, a lot of these contracts or the front month contracts are being rolled. So like the September futures for copper now is going to be the one that you're going to want to focus on. And so like we did have that, that bounce, let's say $4, $3.90, starting to see a little bit of a bounce. And we talked about this too. When I'm looking at from a chart standpoint here is copper typically triple tops. So this might be kind of that first base that's forming, and I'll have Sam kind of talk to the technicals here in a second, but it seems like this might be the first base that's forming. Maybe we do have some optimism post Jackson Hole. I think the market's also kind of preparing for that as well. And maybe we do see a decent little pop. LME stocks are still at elevated levels, so we have to keep that in mind. But from the Shanghai stock standpoint, they are coming down. We also had a strike for BHP. There was a mine, a copper mine. It's the largest mine that's actually out there. I think it produces like 7% or 9%, 7 to 9% of total copper ore in the market. And so they had a strike that they've been kind of working out, and they did work out a deal on Friday morning, which is what it was announced, and they officially signed that deal here today. Now, that typically would be a bearish signal for copper, right? Because you would want to have if you're a bull, you would want to have the disruption of copper ore supplies in order to push prices up. But that's kind of a headwind that's now in the past, or at least in the rear view mirror for now. And I think it's going to just trade technically until we actually have that recessionary data coming back into the fold for the US. I think we kind of have these weird gaps or these waves that are taking place. And what I mean by that, you have ISM manufacturing, ISM services data, regional Fed data that's ultimately bearish and probably points towards a recession, or if not, if we're in a recession right now, I'll just say that outright. That's what those data points are showing. And then you have the labor, the labor data that we had last week, initial claims coming in lower than the street's expectations, 2 weeks in a row below that 240,000 moving average that we've seen over the past 4 weeks, which is also good. And we had some other CPI and PPI data coming in better than the street's expectations, right? So we're kind of having these waves. So it just depends on the week. Last week, everybody was like, man, we're in a Goldilocks scenario. The week before, it was like, let's have emergency rate cuts and the world's falling off the cliff. This week, we have pretty light economic data until you get to Thursday with initial claims. And then Friday, I believe we have new home sales, if I'm not mistaken. We have another homes print that comes out. And then we have Jackson Hole, which Powell will be speaking on that Friday. So light week, I think it allows us to kind of shake out a little bit. But I'm keeping my eye out on copper. I'm not completely sold on it yet that we're going to completely just rip back to new highs. But it does say something that we've seen some stabilization in range-bound activity in prices over the last week and a half. And if you're kind of looking at the commitment of traders report when it comes to copper, maybe we are starting to see some short sellers buying back into those contracts as well. So that's what I'm looking at when it comes to the copper from the copper market. And then if we want, we can talk about silver a little bit later. But copper is one that I've been eyeing for the last couple of trading sessions here, because the price action's actually been pretty. It's been pretty. I would say interesting, and it looks like from just price action and volume and that COT report that we got on Friday that we might have a near term bottom, at least for this week, to try to bounce off of.
For sure, Kevin. I like the copper here. We tried to get back above these prior cycle highs and we failed. So it was a quick move back down towards 4, but the bulls have stepped in and defended that level. So like you were saying, I think the bias should be sideways to higher here. I don't think it just rips higher and breaks out to all-time highs next week or anything, but I like building a position here around $4.
We're all about big, just, let's just say all-time highs, ripping forever and ever and ever. We're probably going to hit $10 tomorrow. Like, Kevin and I like to just talk as big as possible. It's either going to zero or all-time highs, Sam. I can't believe you're going to say that. But no, I like this chart, Sam. I really do like the way the reverse cup and handle kind of is set up. I like the way that you drew it, basically, because a lot of people will look at charts like this and go, well, why did he draw it this way? And the reason why is where's price reacting to, and where's the most bars that we're seeing. These are the high volume zones. If you actually made a high volume chart on this, you'd also see that the volume zone is exactly at around that $4 level.
Yeah.
So, yep. So the highest volume node is right around there. So, and what's funny is I don't have that chart up. I'm just thinking about it just by looking at how many bars are in that zone. So if you're looking at it based on how many bars are in that zone, that's the area where you're going to see the price react to the most. It's something Linda Bradford Rashke used to always talk about that, especially as a short-term trader. She's a swing to even day trading at times. And when you're looking at those things, those high volume levels, those gamma levels, as Kevin also takes a lot of videos about as well, those are the levels that you really want to pay attention to. So I think here, it's a good spot. And once again, like, you want to see a little bit of green beforehand. So we're seeing some green. Now we have a place to basically, if you're a mean reversion trader, you can put a stop right underneath that $4 level. You can try to trade it to the upside. Once again, though, this will probably be range bound. So I agree with both of your assessments on that. I can't think of it just ripping and never looking back here. Even though I'd love to see it, but once again, it is a commodity. Most of the times they're pretty unpredictable, but most of the times they're going to be range bound until they really make new highs.
Yeah, and if you're a Dow theory supporter, right, and Elliott wave, I kind of blend those two things together because I believe the concepts themselves, 80% of them overlap, right? There's a small difference, but if you're kind of looking at waves, and we do have another breakdown, that other breakdown could bring you down to around $3.60. You can make the case that there's at least two waves within that chart that you're showing. And if you're on like the daily chart, you could make a case maybe we're at the third and final wave. But that's just if you're kind of a subscriber to that, and there's an area, once again, 360, I would say your final area of support. We break through that, then we have some really big problems. But just given all of the negative data that we've seen over the last 2 weeks and the fact that it hasn't completely collapsed, especially if you're talking about not last week, but the week before last. The week before last, it was still trading at $4 with all of the stuff that we were talking about there, right? Global economic slowdown, yen carry trade, the risk that we have to the systemic risk, and all of this stuff, and you saw it hold up. That's why I'm just saying the price action seems like it wants to hold up for right now. There's still some optimism that we might be close to some additional stimulus measures right now. So keep your eye on it. I wouldn't get married to a position one way or another. We never do, right? No one ever. No, when I say no one, I mean anybody on this panel never gets married to a position. But I would say, like, from a technical standpoint, soft bullishness and or wait and see. And then if you do have a bear move, 360 is your area of final support until we actually see a final crack.
I'm more in the dating business, for sure. I like that.
That's what you were doing at the rodeo.
Yeah, that's right.
We see you, Sam. I see you. So what do you got next for us, Sam?
Let's talk about crude oil. It's been hanging around this 70 level, struggling to make any upside progress. Seems like we're heading back towards the lower bounds of this multi-year range. I think it holds. Prior resistance turning into support is what we're seeing now. What are you seeing, Kevin? Anything to support my thesis?
Well, let's go back, right? So 2 weeks ago, we talked about this setup, Jason and I did, right? Where at that time, there was some geopolitical things that are on the horizon. We were hitting that 200-week moving average, right? And we kind of had that conversation of looking at volatility and how options were priced. It seems like they were too cheap relative to the anticipation of something actually occurring. And this is why I love these shows. So you guys can always go back and listen to things that we're talking about. We never provide any type of advice. We're just kind of giving you the fundamental plus the technical landscape, and also, every once in a while on the derivative side, when you're looking at the options and looking at an vol skew, right? So this is a thing that I will say that, like, I was actually fairly proud that we actually had this conversation the other week. And I think that it made sense to see that pop that we saw, that peak that we hit at $80, because I wasn't fully on last week. We had Gas Buddy on, so we were talking the week before though, and it was just a nice little rip. You come back down, what you want to do is test 72.50. That's been the area of support that we've been kind of highlighting. I am a little bit, I hate when I say I'm concerned, but I am concerned. This is going to be the fourth week, if I'm not mistaken, under that 200-week moving average. Fifth week, we'll say fourth week under the 200, fifth week closing below it, right, for right now, as far as closing prices. That's not a trend that I like to see. And I've only seen one time where we've actually bucked the trend over the last 20 years, where we stay below that 200-week moving average and try to recoup and push higher. Normally, we do see a further breakdown in prices. I think there's a little bit of optimism when you're looking at the EIA data, though. So last week, we saw a pretty decent draw when it came to gasoline, which is really what you want to see, because gasoline inventories have been built up. We've had the revisions for the EIA, travel data and gasoline demand data. That was actually a positive revision to the upside, but we just haven't had that full thrust in price yet. Now, I'm kind of all over the place, but I want to kind of highlight some things because Andy had a really good question last week. Like, why are the commercials buying right now? So understand this: commercials are still net short the contracts. Okay, so usually when you start seeing that net short being covered up a little bit, there's can be two reasons why, right? If we have an increase in production, you usually see an increase in net short positioning. So shorts continuing to increase. You want to hedge your physical supply that you're bringing online. And then you basically buy back when you don't need to hedge as much, right? We're going to talk about just the commercials. Don't even worry about the speculators right now, because managed money is typically on the other side of this trade. And from my experience of what I've seen, managed money tends to be fairly wrong, and they paper hand a lot more than any type of commercial business out there that actually has a vested interest on actually protecting their portfolio. We don't know what the actual root cause is until obviously the data comes and we can support it. The assumption is that gasoline demand probably has improved a little bit. Also, the assumption that gasoline supplies or refining output probably will be stabilized over the next couple of weeks. We probably will see that in the data, which is why we probably don't see as much of a need for hedging to the downside. Producers sell contracts in order to hedge physicals, right? They buy back contracts when they don't need to hedge physicals. We're seeing the activity right now of producers actually starting to buy back contracts. And so you have two things that could happen: either slowing demand, inventories pretty much peaking, near-term peak. I'm not saying peaking for the year, I'm saying near-term peak, next couple of weeks, and or refining output itself might be stabilizing. I would say 2 out of those 3 are ultimately bullish. And when I say bullish, we'll call it bullish. Price stabilization is bullish right now. If you're crude, right? Price stabilization is bullish. You want to see it actually hold lows. And so that's where I think this price action right now is coming from. Now, I think you're also going to see a little bit of a rotation happening from September going into OPEC's Q4 meeting. Are they going to actually put more production online in the market? The expectations that they're going to bring in around 539,000 to 560,000 barrels per day back online, and they're going to gradually increase production. If they do that, obviously prices will not be able to stabilize. OPEC expectations when it comes to gasoline demand has been revised to the downside, rightfully so, for the remainder of the year. IEA has been doing the same thing. EIA, for the most part, has done the same thing, and they were actually probably one of the first ones to do it around 2 months ago. So if that's going to be the case and they don't expect demand to really spike to the upside, does it provide OPEC Plus an incentive to actually increase production right now and bring more online? No, it doesn't seem like that would be the case. The only risk to that is that your smaller countries are just not going to comply, and they're going to continue to be pissed off, because the less barrels that a smaller country can sell, the less revenue that they're going to be able to generate. And a lot of these countries, 80%, 85% of their total GDP is coming from petroleum-based products in general. So you're kind of in a rock and a hard place, but I would suspect that the market's going to start pricing in, and it probably already has, we don't know, pricing in the fact that OPEC probably will not increase production, at least for Q4, and may wait until next year. And if that's going to be the case, that's going to be price stabilizing. I don't think it's going to rip prices to the upside. 500,000 barrels, 600,000 barrels a day is not like a huge monumental flood, but it's the rate of change or the thought process. Okay, they're going to do it. So if they're going to do it now, are they going to continue to ramp up? That's, I think, is the ultimate fear. If I had to flip a coin, or if I had to make a position or a thought process right now, is OPEC going to really bring production online? I don't think so for now. And if I nerd out just a little bit more. I'm sorry, guys. I hate hogging this, but here's the reason why. Here's another reason why, because I'm in my groove now. I'm in the groove. There's another reason why I think that you would probably see that hold. You have geopolitical tensions that are taking place, right? And Iran is in the crosshairs of that. And so do you really want to see some of the other major producers that are out there, like a Russia or Saudi Arabia, have to step in? Now, Russia would love to see any type of real physical disruption, because they're going to be the major sellers in the East when it comes to oil, right? Especially you have the black market stuff that's happening, the shadow fleets that are going to be out there, all that stuff, right? So is it in the best interest of OPEC as a whole to really bring production online? Is it going to be in the best interest of Russia for OPEC Plus to bring production online? Probably not, because you would have a slide in prices, and everybody really wants to have prices stabilize or move to the upside. Now, if you have a situation where there's this massive eruption of tensions between Israel and Iran, and energy infrastructure is actually disrupted, and when it comes to the extraction methods and or Strait of Hormuz, which you wouldn't be able to shut it down, but if you could actually impact the flow of traffic within the Strait of Hormuz, that could actually move prices up. I feel like there's a situation where Russia probably would not want to support that, and them not also supporting that type of action when it comes to geopolitical action and military action. I think they're also probably going to be on the sidelines and say, okay, let's just hold off. And if they hold off, Saudi Arabia has the capacity, but I think they're going to want to hold off, and they can for the most part right now. So I feel like if there is production assumptions that OPEC production is going to ramp up in Q4, I would say the likelihood of that for right now probably looks a little bit lower, just based on the trajectory of where prices are going at right now in Iran.
No, so another thing I wanted to also bring up, just for people to understand, if you're looking at the COT data and you go over time, most of the time in oil, gasoline, heating oil, gold even, most of the time these things never hit net long. This is a very extreme position that Andy brought up, and this is part of the reason why I have a lot of different signals for COT. One of it's a rate of change. When you start to see the rate of change to this degree, also open interest falling, most of the time it puts in a bottom right around those zones.
Yes.
And once again, there's so many nuances in trading, like to understand. But for me, most of the time, if I'm seeing the right setup, I'm gonna think the signal is possible to go higher, and the right setup is here. But once again, we want to see the price also start to move with it. For the exact reasons that Kevin brought up earlier, is the same reasons why I also think the same as Kevin, where there is a lot of people looking at OPEC. There is the possibility of things changing coming into the year end. And if people are looking at demand continuing to fall to these major levels and all these things, and everybody's fearing a recession, most of the time it can go the other direction. So basically things start to get priced in. Are we sitting at $70 because everybody's going, the world's in a beautiful place, or are we sitting around $70 because everybody thinks it's the end of the world? Probably the latter. We're probably, people are in fear right now. So if we're in fear, that could lead the price to kind of be at this zone. But I like the way this is set up, man. If I was really to look at this and go, okay, this is a major squeeze, volatility squeeze, we start to break out above those levels, like this thing could make a big move pretty quickly. Gasoline looks like it has the biggest big COT signal, but crude oil also looks pretty good in the COT department. So it's interesting. A lot of the commercials are starting to front run some of this, and I like the way Sam drew this chart. And something that we can point to too is, making it really simple in trading is important. Above this line, be bullish. Below this line, be bearish. And this is a long-term chart, so it might not be something tradable for everybody. But you could look for buy signals when you're above this $70 level. You could look at sell signals when you're below the $70 level. So you could just continue to kind of do that until this thing really finds its footing. But I really think the game right here is to be flexible. The bonds giving so many signals, the Fed possibly cutting, not even possibly anymore. I mean, they're cutting for sure. All of those signals could say this could go one of two ways. And volatility squeezes don't tell us direction, whether I think something can happen or not. So if the volatility continues to squeeze and this thing breaks down, that's telling us something. If this thing continues to squeeze and then it breaks up, that's also telling us something. So Sam, what are you seeing on this chart? Are you just looking at the levels here, and are you thinking that crude is either range bound or it has a move coming up?
Yeah, no, it's definitely range bound. I really like how it's turned this former resistance into support. That's what really has my attention, and that it hasn't been able to break down. It's had plenty of chances to do so, but it refuses to do that. And then you look at some of the largest integrated oil and gas companies, like you've got Imperial Oil in Canada making all-time highs. Look at ExxonMobil, looks excellent. You think those stocks are going to be breaking out if oil's about to break down? That's not really the bet I want to make.
Yeah, I like that.
So two things. I hate talking about election plays, and but this is going to be one. I have to say it, right? I got to disclose it. This is going to be one that you have to keep it on your radar as we get closer and closer to October. October will finalize the polling, and we'll probably get a general sense of where things are going to. I think that if you have Kamala Harris and that administration, I think they're going to continue the same policy, which is big bite, but out of sight, out of mind, right? You just do your thing in the background, which is exactly what's going on. And then if you have Trump, if you have Donald Trump getting in, there is a concern from oil executives as well as from Saudi Arabia that Trump is obviously going to try to push prices a lot lower. And there's ways that he can try to do that, right? Trying to either impose additional sanctions or actually basically executing on the existing sanctions, doing that, and then trying to see if other OPEC countries like Saudi Arabia can bring more oil online. So I think there's also going to be a little bit of election risk that is here. The other thing I will say though, and I agree with you, we've been able to stabilize in prices. The 200 week that's my baby. I love that line, so I ain't gonna deviate from it. The problem that I do have though is that it also kind of does look like it's flagging. And if we do have that economic downturn or that slowdown, right? And if we have that data that actually confirms that, and if the market believes that, let me say that, because we can have the data that confirms it, and the market could be like, I don't care, we just continue to ride higher, right? Mm-hmm. But if we actually have the data that actually does support that, I would then be concerned about a drop off, right? Because you're making technically lower highs. I believe you are making, there is a higher low that is in place, but we're kind of still in that channel trend for that higher low right now, and we can't make a definitive point. But I get the bull case. Basically, what I'm saying, it's like a 50-50 coin. If you're an intraday trader, if you're somebody that's trying to swing, if you're looking at a swing trade of a week or 2 weeks, what's the shot? What's the shot here? Are you going to see an immediate and historical breakdown? When I say historical, I mean historical on this time frame. Last I don't even know how many years that is, right? 8 years, 9 years, whatever. Are we going to see a historic break to the downside, or are we going to stabilize here and just kind of have this Goldilocks scenario? So you can make your case that you buy, not a recommendation, but from a technical standpoint, if there's support there at the 200 week, play the pops, sell the pops, right? Play the pops. Geopolitical risk increases a little bit. Play that pop, sell it off, scalp $1.50, $2, right? Sell it off. But from a longer term, this chart does kind of concern me here, right? You have the SR flip as you're talking about. So you would expect that we'd see a rise in price. But if we do not have the macro or the fundamental data to support, we're not going to get to negative prices, I don't think. But you can see, that breakdown and then maybe seeing a 50 handle or 5 handle, which would be around $50. That would be the concern for me for crude.
Yeah, I think the major story here for crude oil for me, especially like when we look at the bonds and I'm going across the board and going, okay, we have, and Kevin, you even know this, I hate this trade. But usually when I hate a trade, it usually is the right trade. So we have the signals, the bond signals are there. We're long bonds, and that can be a situation that crude oil can go a lot lower. So once again, we just got to continue to be open-minded here. If it breaks down, I would short it. If it breaks out, I would go long it. And it's going to tell us something either way.
Good. What else?
Let's talk about gasoline.
Gasoline.
Kind of the same story here. $2 and a dime is the level that stands out to me. We're testing it right now. But you've got the same story, like 4 former resistance turning into support, and gasoline's most likely going to follow the same path as crude oil, so maybe if this breaks down, then we want to start looking to get short crude oil. But until that happens, I think the bias is sideways.
Yeah.
Yeah, go ahead, Jason, knock that
No,
one.
I was just going to mention we're at the moment we have a short-term bottoming signal that we put out a week or so ago. The trade's working out well, but once again, that's not a long-term view for this. So go ahead, Kevin.
I was going to say byproducts will lead crude. That's where we're at right now. I mean, we already have a backwardation being priced in for Brent and crude oil contracts. You actually have contango for heating oil. Last time that I checked, heating oil, diesel, whatever. So, you have actually contango there, or basically a flat spread. I have to actually check here, but last time that I checked last week, we were in contango, meaning that we are now pricing in storage costs there, which is a little bit of a concern. Let me check that for y'all real quick. Yeah, we're still in a contango market. And then for gasoline, we are still in a backwardation phase that will flip, but just understand that that's seasonal, right? Lower demand in the winter months and things of that nature. But I'm a firm believer that the byproducts will actually lead. So if you see actually gasoline breaking out, I think that's going to be your signal for crude. I would say the same thing for diesel. If you start seeing that actually breaking out for whatever reason. Now, diesel is going to have is going to have more of a seasonality effect to the upside. So diesel should actually outperform gasoline in the winter months, just because heating oil itself is still used in the Northeast and in New England, right, for the boilers and stuff like that, even though you're seeing a readjustment to natural gas or either other resources in order to provide electricity and heating. But for the most part, there's still a component there. So you could have a small flip. But what I would look for is byproducts lead. That's what's going to give you that signal. Once you start seeing inventories for gasoline on a week-over-week basis have these nice draws to the downside there, that's what's going to provide price support and even maybe price advances. If you see the same thing for heating oil, that's going to give you another area of price support and price advances, right? The inventory going down, the demand levels stabilizing or moving to the upside is going to then create the more demand for crude oil itself to be able to put through refiners, right? So it's like this, we have this cycle of extraction, refining, you have downstream, right? Goes to the retail gasoline stations, and then we have the consumption, us as consumers. But if we start consuming more, right, that's going to create a draw when it comes to the retail gasoline prices, which that moves that up. A draw on the retail gasoline prices and a draw on demand, or an increase in demand, would also then increase the demand for refined products. That increase for refined products is then going to increase demand for crude, right, in the extraction process. So it's a whole circle. And sometimes we look at it as like crude being extracted, we go to refiners, and then the refiners go to the retail, and then the consumers just happen to consume whatever the hell they want. It's kind of like that reverse when you want to have these nice little price spikes. Let the consumer is going to drive the action, right? Just like in any other market, right? And so I think the byproducts are the ones that I've been looking at to say, when is our signal going to be there? And I've been negative on the byproducts for the most part. I've been heating oil. I'm like, dude, this is, if you're looking at risk reward, but that thing continues to slide, right? But at the end of the day, the byproducts, once you start seeing them outperforming on a percentage basis on crude, that probably gets you your short-term bottoming signal that crude can rip, and that we have actually a firm structural support area that we can work off of. Gasoline has not done that yet. Heating oil has not done that yet. Crude is trying to stabilize when it comes to prices and draws, but that's going to be the key component. And where is that going to come in from? If you're going to have synthetic price increases because you are extracting less, right, and then lower inputs into refiners, you can do that to a point. But if you're doing that and you're still seeing demand breaking down or slowing, then that's not a good sign, right? That's not a good sign for prices. But if you actually see end-use demand starting to spike and increase at a really healthy pace, and it is doing that in some areas, that's what's going to give you the whole complex to be able to push higher. And then it's going to cause those managed money flows to be offsides, and they usually are, right? So managed money is already pretty significantly short energy products as a whole. So it's you only need is a spark, and that's where I'm looking at. But the chart for gasoline, in my opinion, I mean, it's holding that support, but it still doesn't look too great. And there's some supply that's up there too. I don't know what price level that is on your chart on that volume profile. Was at 290?
Yeah, around there. Yeah.
Yeah, so there's supply sitting at that 290 level. So we're 70, 60 points away from it right now. We're trading at 228 and some change, right? So you got to break over that supply level on volume in order to really start seeing this thing rip. And then you break that supply zone, ain't nothing there, right? That's where you can have that nice little breakout.
So what do you got next for us, Sam? Was it diesel?
Yeah, let's talk about diesel. This one looks really good here. You got a well-defined level against 220. We're there now. Does it hold? The moment of truth here.
Yeah, I mean, it's the same thing, Kevin was talking about earlier, so we don't really need to go over it again, but if we're just looking at it here at basic price levels, your risk to reward looks pretty good.
There is a problem.
Ahead.
Go do your thing, and I will add something about diesel here in a second. Go ahead.
Yeah, no, the risk to reward looks good, but it's not something I would buy. It's not a chart I would suggest buying. I would just wait for some price confirmation, some momentum behind it, getting above, that maybe that right shoulder, that $2.80 level, something like that. Go ahead, Kevin.
So here's the bad problem about heating oil and diesel over the next couple of trading sessions. So there might be a strike in Canada when it comes to rail, which could actually impact CNI, Canadian National Rail, or CNI, the Canadian National. So that's a stock that is actually moving to the upside here today, and I'm actually surprised by that. So if we actually do have this strike taking place, and there's already things that are actually happening. So Maersk, remember Maersk, we were talking about them during the Red Sea shipping issues, right? And they were like the big headline. Well, they're stopping accepting inventories going into Canada, because if they do have a strike and they can't use rail, then that's a problem. You can't transport anything. And so they're not just going to build up inventory. So Mayor says no dice until they actually figure this thing out. We're not going to take on any new import going to Canada, because they're just not going to be able to ship it. If that's also going to be the case, and you do have a shutdown on the rail, a lot of diesel and energies in general is used in locomotive and freight. So if you have a stoppage in freight, you're going to have also then a slowdown when it comes to demand. This is a completely underreported story, by the way. Mm-hmm. So if you're watching this, put it on your radar. Put it on your radar, because you're talking about an event that will literally just destroy all of the inflationary gains that Canada has had, and it probably will have an impact on us here in the United States. No one's talking about it. Now, I think it's probably underpriced because they think that there is going to be a resolution. But if we don't have a resolution, and you already have Maersk coming out and saying, look, we already have to make plans that you guys are not going to be able to move cargo, that's a problem. And so it will also have a negative impact. In my opinion, it will have a negative impact on fertilizer and grain. And if you're looking at the rail system itself, you're kind of focusing more West Coast, right? Going into California, Washington, Oregon, and then kind of moving up. That's really the corridor that you're worried about. Now, fertilizer has already been used for our growing season. So will you have a disruption there? Will prices increase? Maybe, yeah. But how concerned are you about fertilizer? Because you're not going to really need it until early spring anyway. So I'm not concerned about that. But you could also have a disruption in grain shipments. That could be a thing. You can have a disruption in lumber. And I don't know what lumber is doing today, but keep your eye out on lumber. So the reason why I say that is if that does go down, the consumption of diesel will also go down. That could bring a negative price pressure in for heating oil or diesel futures. That's completely separate from all of the other fundamental data that we talked about. So I just wanted to bring that on the radar.
So Kevin, and this is kind of a good time for a little learning for people out there who haven't paid attention to things like this yet. When you're seeing this stock, and you said today the stock is up, What do you think that's possibly saying?
Well, I mean, the broader market's up right now, so we have to keep that in mind. I mean, if you're looking at pretty much all of the rails, Union Pacific up 0.5% right now. Let's even see CSX, which I think is probably the least the one I don't like the one I don't like the most, but that's up 0.6%. So I just think industrials in general, just because of the broader equity market, is just up for the most part.
How much is that stock up that you were talking about?
So it's CNI is Canadian National Railway. It's up almost 1% today.
Okay.
So I don't see how that's bullish for this. Now here, okay. It could be bullish that if you have a strike that's going to take place potentially on Thursday, could you have a disruption in services, and then when you have a disruption, out of that, can you raise prices, freight rates? Yes, right. Like that's going to happen. Is that going to be a tailwind for them in the longer term? Maybe. But I feel like if you're going to have a disruption in your operations, you're going to have a lot of deferred revenue that's there. And if Maersk is saying, hey, we're going to stop shipment, what are they going to do? They're going to look for other avenues in order to try to get product to their customers. Now, is that going to be intermodal, or is it going to be straight ground? Is that going to be diverting over to Long Beach in California? Are you going to look at more of the Union Pacific and BNSF? BASF, I'm sorry, to be able to move freight. Like, who knows? So I don't think it's like a cataclysmic, oh my God, the world's going to end. This isn't like our Suez Canal scenario, right? But it is a problem. And so if it does go through, and it might be a nothing burger, the market's been pricing in a lot of nothing burgers lately. And if it's a nothing burger, then yeah, the stock might not be impacted. But if it does go through, then you're going to have a problem. Canada will have a problem when it comes to inflation. They already have a problem when it comes to inflation. And it'll be even a bigger problem for them. Do you have the lumber? Do you have lumber prices right now? Can you see what lumber's doing? I haven't checked it out in a long time. Or Sam, if you guys have.
I mean, just that it bottomed pretty recently out of that major support zone. It's been moving up ever since. Yeah, it's basically bottomed all the way back in June. And then it's just continued to kind of move up choppily ever since.
Yeah, I think it's down a little bit today. So yeah, just keep your eye on it.
Yeah. I mean, my thought on why I brought it up is, sometimes for me, if I'm looking at something like this and I'm going, okay, well, why the hell would the price be up on this today? And why would it be outperforming? Sometimes that tells me that someone somewhere knows something. Yeah. Either that it's not going to happen, or or something. I don't know. Like
it was already priced in, and it's not as bad as what was anticipated.
Who knows? It's something though, and I think that's the interesting thing about the price action today. Sometimes I'll see that sort of scenario in random things, and I'll be like you mentioned earlier about ExxonMobil and some of these energy companies, and then if you're looking at crude oil and you're going, crude oil should catch up because of blank, like. It's us crazy technicians that always think about these things, but it happens a lot, though. It happens a lot. So a lot of things to look at there and pay attention to.
And they're not really worried about oil exports, too, because a lot of the oil that they're exporting from Canada are going through, there's enough capacity in the pipelines to get things. So I'm just talking just consumption side.
Consumption side, mainly diesel and gasoline?
Yeah, mainly just diesel.
Mainly just diesel.
Yeah.
So what do you got for us next, Sam?
Yes, let's talk about natty gas. Found support at the $2 level. It's bouncing. What do you guys think? We got a big volume shelf here at 260. That could be some resistance on the way back up, but I'd be very interested around there. You're seeing stocks like LNG set up very nicely.
It's been setting up, man. LNG is just a workhorse. Doesn't care about what the S&P 500 is doing. It's just going higher. So once again, this is the contract change scenario too. So Jason, you want to hit the contract change items?
Yeah, let's talk about it. Go ahead.
Okay, so basically we have a rolling of a contract that's taking place. So natural gas has seasonal structure, pricing structure when you're looking at the curve. So if you're on Toss, or if you have like any platform that you could see the actual curve for futures, you'll see this situation where natural gas prices go in this U shape, right? Or kind where we're at right now, it's going to be kind of like an N shape, if you will, right? So you're seeing us getting closer to the winter months. That's when we usually have draws. We start having draws typically starting in October, give or take, depending. So we had a roll of a contract. That contract that we have right now is being priced in a little bit higher. There's also, weather forecast from the Almanac that has come out. Like Colorado's supposed to have like one of the coldest winters in a very long time. So those predictions and projections came out this weekend. You have a refining operation, or basically a gas operation that's being reported that got hit in Russia. It's like the second time that's happened. There was an additional explosion this morning. I think that's also pushing prices to the upside too. There's a massive demand pressures out there when it comes to Egypt, because they are literally having issues with their electricity grid. We all know what's happening in Lebanon, right? In Lebanon, they're having literally blackouts in Beirut, which is kind of unprecedented there. So there's a little bit of a demand concern that's happening for natural gas. We're still in injection season. Europe has been injecting a little bit slower than what we would have expected, but they have more than enough inventory on hand. Last time I checked on Thursday of last week, they were sitting at around 88% of total capacity for their storage in the EU as a whole. That's good. But I think you're just having a situation where contracts roll. You have individuals getting out of one contract and then getting into another one. This is a contract that is heavily shorted, right? And so if you roll a contract and you're short that contract, what do you have to do? You have to buy that contract back, right? And then short the new contract. So that's most likely another reason why we're seeing this math. I would call it actually a really decent pop here today. It is setting up nicely from a technical standpoint, but there isn't just enough fundamental for me yet to say, hey, natural gas is like the play to make once we get to mid-September. You'll know, Jason and I will literally talk about it every single Monday from October on out. That's just going to be the thing that we kind of talk about. So that's what I'm looking at when it comes to Natty. If we have a bigger escalation or a second major offensive in Ukraine from Russia, that could be another thing too. We know that there's some geopolitical things that are happening over in that space, and so that's something to keep in mind. But there hasn't been anything that's like, oh man, this is like the bottom for Natty yet. Doesn't mean it can't happen, but yet. What do you think?
Yeah, I agree. I mean, it's a tough trade, right? And natural gas is always a tough trade. And if we look at it, though, something that's important to talk about here, which is when we get into these later summer periods, there's a very high probability that there's a major pop in natural gas at some point. We see it usually in August, September, especially into October. That's when we have a more structurally bullish market for natural gas. But right now, like, I'd be ready for pops. But they usually fade, but that doesn't mean anything. I think to me, it's we have the setup here to go higher. We do have a setup here to go higher, but I want to see us really kind of break out of these major levels. We've kind of continued to just go into these major levels over and over again. And something I always talk about with natural gas, if you want to catch these big moves, move from $2 all the way to 10, that's a huge move. That's a ridiculous move. You have to have incredibly wide stops, incredibly small positions to trade this well, or it will be the Widowmaker trade. Every pullback will cost you more money than you could ever dream of. So you have to trade this really small. You have to have a very wide stop. You have to be willing to let those breakout levels happen. Like Sam's looking at 260. I don't think there's anything wrong with, on the front month contract, looking at 260, then paying attention to the contracts that are further out, seeing if those clear those major levels as well, and then getting into a position. But a lot of people always want to buy dips in natural gas. I always tell them that's the biggest losing game in finance. Like, you will lose so much money trying to buy a dip in natural gas, or saying this commodity looks cheap. most of the time, a cheap continues to stay cheap or get cheaper. And most commodities, they usually base for a long time and then they break out and then they V top. So, there's a lot of things you're going to have to pay attention to here. But I think the same thing is Kevin's thinking. We could go sideways here. I wouldn't be surprised, but also just like Sam's pointing out, keep it simple. Get over some major levels, take a swing at it. I wrote a post the other day about taking shots at things. And there's a great quote in there too from Paul Tudor Jones. It talks about how it doesn't sound that cool to say Paul Tudor Jones buys the bottom of the bond market on his 5th attempt, but that's the truth. And like that's Paul Tudor Jones telling you, like you don't just hit your trades the first time. So I think one thing that we don't talk about enough in trading, because when we're analysts, like the whole goal is to get it right, but as traders, like you have to take shots. It could be completely right that natural gas is bullish here. Let's say that's completely right, just to illustrate my point. Completely right. Natural gas is bullish, but natural gas could stay here. Natural gas could chop around. You could get stopped out 5 million times. You could get frustrated. Like there's a bunch of things that can happen, even in the fact that you are right. So you have to understand the difference in those two things. You have to trade small. You have to risk manage properly so you get multiple attempts at a trade like this, because these trades can be incredibly lucrative, but you have to risk manage properly to do so.
For sure. I'm not like Mr. Monthly MACD guy or anything, but if you zoom out on natural gas, like you were saying, it takes time to base. It's sloppy. You get chopped around. But once the monthly MACD crosses, you tend to get some upside momentum going. And we got that recently. So I think there's be resolving this base pretty soon.
Yeah.
We have a short term. I hope you're right.
Keep your eye out on your feeds right now. I would suspect there might have been a deal announced here because crude just dropped off about 50 cents. I don't know what the news flow is right now, but we just saw a pretty decent sell-off in crude and in gasoline over the last 2 minutes, 3 minutes. So keep your eye out on your feeds. This is for you intraday traders. But it seems like something must have hit the wire, should be hitting the wire here soon. That caused that sell-off.
Yeah, let's talk about gold, guys. I'm excited about this one. So we've got gold here. I zoomed all the way out to show the multi-decade basing pattern. We put the finishing touches on that earlier this year, around March. We've hit the first extension level, consolidated there for several months, and I think we're making our next leg higher here. Closed last week at the highest price in history. Not really seeing follow through today, but let it dance. We saw some major moves from some junior gold miners last week as well. Several of them were up like 50%. It's been a while since we've seen that.
Yeah. Gold hitting all-time highs is definitely something to continue to pay attention to. We've been talking about this for a while. I mean, that's the one thing that I've been so happy with that. And like Kevin mentioned, we've been putting this stuff out for a while. At the beginning of the year, we started this all out with a options trade idea, not advice, just my thoughts on an options trade that Kevin and I were talking about. The options pricing being the options volatility and the pricing for options being incredibly low. Time to buy options, the premiums were low, and so on. Buy some options in oil. We get that great pop in oil. And then we've been talking about precious metals for a while now, too. So you guys can go back and check out all that stuff in our past videos. But when we're looking at this, this is a structurally bullish market. And also when we're looking at it, something to pay attention to is what usually happens in the cycle. The cycle usually happens if you're looking at bonds. Gold usually starts to bottom, starts to make a big move. And then finally bonds catch up. We're starting to see bonds catching up. Gold really likes this type of environment. You have the yield curve coming out of inversion. It loves this environment. So I would think that we're going to see gold prices probably go a lot higher here. we've been talking about 2,500 for a while. It's over 2,500 now. I certainly think we could hit 3,000. But once again, these are just even numbers. If you measure it out and you look at what Sam has written up here, 3,300 is possible. So if we can sustain over this 2,500 level, I don't see any reason why we can't hit that. Silver also is looking really good. Silver is actually leading the way lately again. That's only on a daily time frame. I would like to see that on a weekly to get really bullish on this space. The miners look great. Most of the majors are doing really well. Some of the juniors are starting to finally tick up. This is just set up for a major move in precious metals. And most of the time when we see all these ingredients coming together, that's not something that we'd look at and go, okay, well, that's going to just all of a sudden stop. It just looks right. So once again, gold looks really good to me. I'd start to get more into the other areas like the miners, silver, possibly platinum at some point. See what's going to basically play the catch-up trade. Kevin, what are you seeing in the precious metals market? And we'll just kind of end it after Kevin.
Yeah, well, gold. I think we talked about this earlier in the year. This is the level that I think gold peaks at, and I already know that I'm wrong. So gold usually breaks up. So we kind of talk about it. It range bounds, right, for years, and then it has its own reset, breaks to the upside or breaks to the downside. Then it kind of trades in a range. I mean, we kind of see it on that chart there. This is the breakout, and then I believe that it was going to range between 26 to peak out at 2550 would be the upper end of its range. And having 2450 to 2425 as its low end of the range in consolidation, I probably am going to be wrong on that, and I'm perfectly fine. I mean, you still have central banks that are now resuming the purchasing, especially when you're looking at China, resuming the purchasing of and increasing the purchasing of gold.
How long did they stay for? It was just a couple months?
2 months. Yeah, it was 2 months where they held off. And it's still not like aggressive that what they're doing now, but it's something, right? It at least shows that they're still trying to get in, and if you can do that, then that's good. India is another huge buyer. The Indian central bank is a huge buyer of that. Their government is a huge buyer of it as well. If you look at jewelry demand, and this is going to sound crazy, but jewelry demand in India is actually like very robust. Just in general, and it's actually a big cornerstone or a big piece of the gold trade just in general. It's actually fallen off a little bit, but the central bank buying has really overtaken that. So you have the fiscal concerns about fiscal spending, right? That's also kind of putting a bit into it. You have the dollar trading at lowest level since January. That's probably also putting a little bit of a bit to it. Risk reward. I think silver still has a higher beta, but gold has definitely been able to outperform so far. I want to just highlight once again, we're not tooting our own horns, but we have to start bringing these things. I feel like we have to start circling back so people understand the value that they kind of get here, Jason. So once again, 2 weeks ago, we talked about the oil trade being underpriced, right? The potential pop, right? We talked about that earlier, right? You can go back 2 weeks ago and kind of talk about that and the potential risk that's out there. I at the same time, I also brought up shipping companies, right? Zem Integrated. Zem had a decent earnings announcement. It was pushing to the upside. Zem is up 23% today in today's session. So they're seeing that premium, right? They're seeing the premiums being built in because of the issues that we've seen in Israel, and they're Israeli shipper, but they have pricing power. And so that's just another example of just pricing power being built in, maybe potential disruptions being priced in to the stock too. And we usually don't talk about individual stocks on here, but kind of talked about the shipping side of the economy that could also see a little bit of a boost. And their earnings announcement is just kind of fueling that. I still don't have the reason why crude is literally falling off of the map right now, sitting at $74. But crude has literally dropped basically a dollar in a matter of 5 minutes. Well, actually not 5 minutes. In a matter of, I'm on a 5 minute chart, matter of 25 minutes. So if you're trading on an intraday basis, be mindful of that. Scrape your news feeds. We don't know what's happening, but it's a decent drop off that that is more than just probably technical selling that's taking place. So.
Sounds good. And so, all right, we'll end it there. You guys, if you guys are still with us, definitely make sure to hit the notification bell on YouTube. If you go on YouTube, I know everybody's on Twitter, but on YouTube, you can find a playlist. You can go through all of our old videos much easier. And you can check back with us at any time. And also, you can chat with us on the chat, ask us questions, ask us things that you guys want to look at. We'll cover that as well. So thanks so much. Make sure to follow the speakers. We've got Kevin Green and Sam today. Sam, thanks for coming and joining us today. As always, bringing some great charts. Very clean. Great way to do it. Sam's doing a bunch of reports now at All-Star Charts. So, check that out. Sam's going to be doing a gold report and so on out of there. So make sure to check it all out, and we'll see you soon.
Thanks, guys.
See you.